Let's get the more perspective on this latest inflation read with the former PIMCO chief economist, adjunct professor at Georgetown, Paul McCulley, joins us this morning. Paul, it's great to have you. We're seeing a lot of commentary like, oh, it's a blip. We know the Fed pays more attention to PCE, where housing's a smaller component. What do you think?
I think that's true, but it misses the big picture, which is that it's going to be difficult to get from 3% to 2% on inflation, called the last mile. I don't think it's a huge problem for the economy, but it is a problem for those who are all dressed up for a big easing party this year. So I think the bottom line from today is the Fed's dot plot from December, which penciled in 3 cuts this year, is looking pretty good. And I think the marketplace needs to quit fighting the Fed and essentially get in line with where the dot plot was in December, which I anticipate the FOMC will roll in the March meeting.
You think Fed credibility gets a notch up today, especially after you mentioned the dot plot, but also even Powell's comments on 60 Minutes?
Yeah, I do. I think Chair Powell has been exquisite in how he's laid out the path to easing. He wants to be cautious. He wants to be careful, and he wants to have more confidence that what we've seen over the last 6 months is going to endure for the next 6 months. I think Chair Powell is looking very good in his storytelling today.
Another element I made here, just in terms of what surprised us to the upside in these CPI numbers, Paul. So food, I mentioned food at home, so that's grocery, food away from home at restaurants. Shelter is a biggie, 0.6% was more than expected. Transportation services, medical care services. Why is the services sector remaining so stubbornly high in terms of pricing and demand?
Well, a lot of services prices, like insurance and so forth, by definition, are going to be lagging because they're catching up with what happened in the past. I think it's basically telling us that it's going to be a long slug further down. And the one that is bedeviling, and we've talked about this before, is the homeowner's equivalent rent. And it just refuses to crack in line with new rents that we're seeing in the marketplace. So I think all of us, and the Fed included, are frustrated with this, but it is reality, and we have to live life on life's terms.
But that's on the Fed, isn't it? I mean, if there's one part of inflation they were supposed to be able to control, it's the housing market, because that's where they raise rates, they raise mortgage rates, and we just haven't seen the kind of come down in prices for house prices or rent prices that you would expect.
I think you could say it's on the Fed only if you want to go back to them being too easy a couple years ago. Where we are right now, I don't think is on the Fed. The Fed doesn't own what homeowners' equivalent rent's going to be on any given month or any given quarter. It is the calculation. And again, it's bedeviling, because we're seeing in the real world new leases are disinflating, but we're not seeing it in effectively the imputed prices for owner-occupied homes. So I would not blame the Fed for homeowners' equivalent rent today. But you can blame them if you want to. I wouldn't, but blame them for what happened in 21.